everyone. Welcome to this week's webinar. Today, we're going to be talking a bit more about investment planning and how to incorporate your risk level in your portfolios with your age as you get closer and closer to retirement and get ready to start spending down some of these accounts that you've worked so hard to build up over these years. So let's dive into the presentation today. And if you have any questions, feel free to post in the comments throughout, and we'll make sure to get those answered. All right, so talking about how risky should your investments be based on your age. So as we go through this, I want you to be thinking about how far out you are from retirement and what you've done so far on your investment strategy, or if you have someone helping you with it, you can take a look and see what you have set up right now and use this hopefully as like a cross-reference as we go through this today. So understanding what investment risk is and what it means. I think when people think of risk, they think of losing all their money, right? They think of going to the casino and putting it all on black and seeing what happens, right? And there's a chance that you can go to zero. That's a little bit different than what I would say is like aggressiveness. Aggressiveness is more like, how aggressive are we going to be pushing our investments? How likely is it that we have a negative return in our portfolio in any given year? And how big can that negative rate of return be, right? A more aggressive portfolio is really just going to be fluctuating up and down more throughout the course of the investment strategy, compared to a risky investment is going to be an investment where you could potentially lose all of your money. We use the word risk and aggressiveness interchangeably. For this presentation, when I say risk, just know that aggressiveness, all right, anything that we're talking about today, if you're doing this strategically, the chance of running out of money or losing your money is not really there. It's more just how big are those fluctuations going to be. So when we think about that, we think about how we're building our investment portfolio. At the highest level, we look at what the stocks to bonds ratio is in your portfolio. So stocks are more aggressive. They're going to have a higher rate of return. They also could have big negative years, such as 2008, where we saw a 45% drop in the stock market. But in the long run, it's going to go back up and you're going to get that higher rate of return. Bonds are going to be the opposite. Bonds are considered safe. Instead of you buying part of a company, you're actually just acting as the bank lending the company money. So you're getting a more consistent interest rate and rate of return. So there's less fluctuation there in your portfolio, and that's going to add some stability. The downside, as you can see, is stocks can earn around 8% on average, where bonds can earn 4%. And then if we really went safe and went to cash, we could be actually losing 2% of your portfolio every year of your cash account to inflation, right? The balance doesn't go down, but the amount of things that money can purchase goes down over time. So we want to be investing and have safety in our portfolio. But if we go too safe, we won't have enough money to actually make it through retirement. So a lot of people think that like when they get to retirement, they're going to go to a very safe, conservative portfolio. But the reality is that you could be in retirement for 30 years. So you need an investment portfolio that can last 30 years of inflation and 30 years of market changes and 30 years of retirement where you're not bringing in income to make sure that you don't run out of money and you have a bulletproof financial plan. So we need to stay more aggressive than actually what people think. And so I have here just kind of the reality check. So you as a court reporter, for those of you who are freelancers, you don't have any pension. So there's nothing that's guaranteed income. So for some people with pensions, maybe the extra money is really just like for fun, play money for going on vacations and things like that. But they know they're going to have this consistent pension paying out every month. But for most of the people that we work with and talk to on the freelancer side, you got to do everything on your own. You're going to get some Social Security, but it's not nearly enough. We need to make sure we have money that's going to get enough growth to make you last all the way through to retirement. So one of the old rules that you may or may not have heard in the past is actually the rule of 100. And what it is, if you are 0 years old to 100 years old, whatever age you are is how much bonds you should have in your portfolio. So as you can see here, it says a 30-year-old should have 30% of their portfolio in bonds. where a 60-year-old should have 60% in bonds. And basically the philosophy here is that as you get older, you're adding more and more bonds to your portfolio. This is an old strategy that we really don't use and don't recommend anymore. And the main reason being is that it's not enough to keep your money growing through retirement if you follow this strategy. You retire at 65 and 65% of your portfolio is bonds. You're going to sacrifice way too much rate of return, and your portfolio is not going to last a potential 30-year retirement. Also, there's things like healthcare costs growing faster than inflation. You have irregular income, and so we need to make sure we're capitalizing on the good months that you have to grow your portfolios. And again, you don't have a pension or anything like that to fall back on. So there's two pieces of risk that we want to think about. And the way that I like to think about this is how we would invest if you were a robot and you did not care what happened with your portfolio, and then how we actually invest knowing that you're not a robot and you are going to be emotionally tied to your portfolio and the rate of return there. So the first one, the robot mentality, would be your risk capacity. So this is what could you afford to lose just based on a number standpoint from your financial plan. So, time until you need the money. If you have 15 years till you're ready to retire, then we have a long time we can be more aggressive because of that. If you're 2 years out, we need to be a lot safer. What other income sources are you going to have in your retirement is going to change how we invest, what you have in emergency funds built up, and of course, what family financial obligations. So all of these are objective data points that we would use to figure out how risky or safe you could be in your portfolio. And that's where someone like me comes in, is really helpful for our clients, is that I can look at it from the sidelines where, I'm not tied to the money the way that you might be. And so I can tell you, here's how you should be investing relative to what your goals say and what your financial plan looks like, without thinking about the emotional side of investments. So once we figure out the risk capacity, I think that's like a good starting point. And then we are going to go safer or more aggressive from there, depending on your risk tolerance. And more often than not, we're going a little bit safer than what your risk capacity says, where people aren't as comfortable with seeing drops in the market. So that's where we can look at what is the worst case scenario that we've seen on that portfolio in the last 20 years. What's something that you could expect to happen? Are you going to be okay with that? Are you going to be giving me a phone call saying, Brandon, what the hell's going on? The market just took a dump and I don't have any money. Where is going to be the point where you can look at your portfolio and just be like, hey, everything's fine and we're in it for the long term and we don't have to worry about it? And where's the line where we start to freak out, cause unnecessary stress, consider taking your money out at a loss, right? All those bad things that we want to avoid. So to give you a general idea, is someone in their 20s and 30s in their growth phase, instead of being 20 or 30% in bonds, we should be as aggressive as we possibly can here, 90 to 100% in stocks, right? We really don't need any bonds unless you are really adding them from a personal preference standpoint. But from a risk capacity standpoint, we know that there's never been a 15-year period in the market that had a negative rate of return. So someone who's 30 years old has at least another 30 years to grow this portfolio. That's a long time of growth that we're going to see in this account, and any recessions that we see along the way will be a tiny little blip in the portfolio looking at it long term. So we can go aggressive. And as you can see, by having that aggressive mentality here, $1,000 a month for 30 years would, at 8% rate of return, so an all stock portfolio, would yield you 1.35 million. So essentially you would have $1 million of growth, and the 350,000 or 360,000 is what you would have actually put in yourself. So a lot of growth there and benefit. Once we start getting closer to retirement, we're now in our 40s and 50s. We're still growing. We still have a long time. If you're 40, you still have potentially 25 years till you need this money. We want to still stay aggressive, but maybe we'll back it down a little bit and add a little bit of bonds to the portfolio. If we experience a big drop now, number one is it may take away a little bit from our retirement goals. Number two is it actually gives us some opportunity to take those bonds and buy stocks when they're at a discount. So if anything, it's a little bit more of opportunity to have some bonds in the portfolio and be able to make adjustments on the fly as needed. Now, once we get into our later 50s and 60s, now we're really thinking about retirement and what that's going to look like. And now we want to bump up to closer to 70 or 80% stocks and 20 to 30% in bonds, or I would say bonds or cash at this point. At this point, we want to have about 5 years of expenses that's sitting in either bonds or cash. And you could probably just split that in half. And that's your safe money. And then the rest is the stocks. And the way that we think about it is if everything goes well in the market, you get to pull from your stock portfolio. If things aren't going well in the market, then we're going to turn to your cash and bonds. So essentially, you could go 5-year recession where your stocks are down for 5 years and you never had to pull from those stocks and you could just use the bonds and cash that you had sitting on the sidelines. Now, as you get later into retirement, we will want to start going safer and safer, adding more bonds to the portfolio. But the reality is here, we really never need more than 5 to 10 years of expenses sitting in cash. That math and that strategy will tell us how much we can still have in bonds, but usually it's going to still be a significant amount compared to what most people think at that point in their life. When do we need to dial down the risk a little bit in your portfolio? So you may want to consider having a little bit more bonds than some of the numbers I showed. If you are not fully funded on emergency funds and you have less than 6 months set aside, we probably want to have a little bit of safety, because if the market drops, the bonds is going to be our additional emergency fund that we can pull from, because they typically don't go down when stocks do. So that's like our extra emergency fund is the bonds in your portfolio. Ideally, you get closer to a year's worth of cash and expenses set aside. And then at that point, you can start to dwindle down those bonds back to maybe where you should be. If you have a major expense coming up, and this isn't a retirement account that we're talking about, but something you're going to be using much sooner, then we'd want to have a lot more bonds in that account because the timeline's much shorter. If on the emotional side, you're a panic seller and we know that we're not able to stomach a downturn in the market, probably going to want to be a little bit safer there, right? And then lastly is just income instability. If you know that there's income instability or potential health issues from you or your spouse, and you want to build a little bit more buffer, again, adding bonds on top of your emergency fund is going to give you that extra peace of mind. Now, when can we go a little bit more aggressive? So you can start to dial things up a little bit when we've met that 12 months of emergency fund, 12 months of expenses set aside, and we have that safety net. If we have some income stability, maybe your spouse has consistent income and your income's fluctuating, but you know you're going to always have this backup income from your spouse, that's going to help a lot. If you're comfortable with market corrections, you don't look at your portfolio and you know you're in it for the long haul, then we can be a little bit more aggressive. Longevity factors. So again, going back to that risk capacity, if you know that you need this money to last till you're 90 or 100 just based on family history, we probably need to go a little bit more aggressive and keep that aggressive nature to make sure that we don't run out of money. Lastly, we never want to do this, but it is always a backup plan if you have to, is if you're catching up. So if you're behind on retirement, we may have to go more aggressive than you should because you need to catch up and make up for lost time. So again, this is the last resort. I never really like to talk about it because it's adding a lot more risk to your portfolio where we could see a recession and you have to keep working a bit longer than expected. But if you're behind on retirement, it's really the only way to help accelerate that is to increase your stocks in your portfolio and go a little bit more aggressive. So lastly, what's an action plan that you can take away from today's webinar and implement for this week? First and foremost, like I mentioned, hopefully you know how many years until retirement, or at least a rough idea of what that's going to look like. Log into your accounts and check your stocks to bonds ratio right now. Where are you sitting at? How does that align with what I talked about today? And what changes might you need to make to get back on track? Look at the, I just mentioned this actually, matching the current allocation with the age appropriate target, right? So looking at what we talked about today. Adjust if you need to. So rebalancing Basically, you're going to be selling one part of your portfolio and buying the other, right? Selling some stocks and buying some bonds to make that change. So if you see that you're way off right now from some of the things I talked about today, maybe it's over a 10% difference between what I'm showing you, talk with your financial advisor, do some research, and see if you want to make that adjustment and rebalance your portfolio. And then lastly, set up some type of automation here to keep tabs on all this stuff. So you always want to be looking at your portfolio at least, once a month to just see what's going on and make sure nothing crazy's happened. So if you're someone who's just really set it, forget it, at least set up some type of system where you have it on your calendar every month just to check in, see how things are going. And what will happen naturally is stocks will do better than bonds. So you may have started with a portfolio that was 70% stocks and 30% bonds. But because one did better than the other, it may start to skew, right? At the end of the year, you could end up being 73% stocks and 27% bonds, and you may want to adjust that back to where you started at and take some of those profits away. So hopefully this was helpful today. Let me know if you have any questions in the comments. Happy to get those answered for you. If you do want to set up a meeting and talk about your own individual plan and put together a complimentary financial analysis, I'm happy to do that for you. Feel free to either send me a message or I have the link in the description or comments in the video, and you can find a scheduling page there. Other than that, hope you have a great rest of your week, and I'll see you all next time.